Good evening, everyone. And today we're going to get started with the first video of a three playlist part series. The playlist is called An Investor's Guide to Investing, which is coincidentally the name of the document. This playlist will focus on what I perceive to be valuable investment strategies and principles that I've gathered over my years of investing to help consistently produce profit and try to minimize losses. Once again, this is from my own perspective, and this is not to be taken as financial advice, but I'm hoping that this will be entertaining and at least somewhat educational. Now that said, there's also going to be two other playlists. There's going to be also a gambler's guide to investing. These are typically errors or kind of very risky behaviors that I see when sometimes retail investors make within the market, such as kind of buying options, buying zero DTE options, maybe over leveraging themselves, using margin excessively, continuing to push their gains when they're the market is or the stock is at all-time highs and so forth. So that's more to the gambler's guide to investing. And then the third instance is going to be a hedge fund's guide to investing. That one's going to be a little bit more about how institutional ownerships, mainly hedge funds, will use more advanced strategies to be able to kind of play around in the market, to kind of hedge themselves in a sense, using strategies like protected puts, iron condors, and so forth. So a little bit more advanced, we'll be kind of talking about more advanced option strategies or spreads that can be used in those cases. But as far as the investor's guide to investing, this is more specific to the way that I tend to invest and my thoughts. So I do have a bit of a bias in the sense that I'm saying it from my own perspective, but I hope that other people that are kind of in this domain or kind of looking to invest as well can at least see the reasoning for my approach. That said, let's go ahead and get started. I created a document that kind of goes over these principles, and so we'll go through it bit by bit. Over time, I'll improve it, and then that way it kind of gives more clarity as to how I typically invest or what my viewpoints are. But additionally, maybe it can even serve as a document that others can use and reference while kind of performing an audit of a particular stock. That's it. Always make sure to do your own due diligence, and this is not financial advice. So let's get started with core assumptions. These are things that I tend to hold true, and they're kind of like my driving factors for investing. So number one, I do believe the overall market will increase over time. We've seen this to be the case with the market. If you look at, let's see, SPY or the Dow Jones or NASDAQ, the Dow, and so forth, you could see that generally speaking, the market will compound at about 10 to 11%. Differs depending on sources, but let's say about 10 or 11% per year of compounded annual growth. Next up is that the market sentiment has an impact on the short-term stock price. So this is something that I don't think sometimes retail owners understand, and that's that retail ownership understands, which is, let's say, for example, everything's going well for a stock. It's had good news, it's had increased revenue, it's beat on earnings, and suddenly the stock price drops. Now, why could that be the case? It's because market sentiment, or how the market overall is doing, not necessarily the economy, because they can kind of be tied to one another, but the market, let's say if SPY tanks, the stock that you're looking into will probably also tank to some degree. So especially if SPY goes down, let's say during COVID or the 2008 recession, whatever it may be, then your stock will go down. If your stock is doing maybe not as well as you would hope, maybe it's kind of stagnant, or in terms of news, in terms of guidance, it's kind of stagnant, but suddenly you notice it going up. That may be due to the market sentiment. Maybe SPY is at an all-time high, it just keeps going higher, and then because of that, your stock gets a bit of a boost. And there's a saying that a rising tide raises all ships. That could be the case with the market. If the market's doing well, your stock will be doing well, and vice versa. Next up, a stock's fair value is typically a range. Now, I do believe that to be the case. People set up their own DCF calculations and kind of intrinsic values on a stock, And because of that variation within what may be going on with the stock from day to day, within the parameters that you set for your DCF calculations, a stock price may be valued at around, let's say, like fair value, $90 to $100. So that's what it, on average, should be, or what we expect it to be fairly priced at. It's, you can't say for certain what it'll be at, like let's say 99.50. It's really specific. It's hard to say what the actual parameters would be, but I typically accept it as a range. Now, the tighter the range, the better, but obviously we don't want something like $0 to $200 because that's not very valuable. But if it's 90 to 100, it gives us a good idea of what our purchase price should be around. Next up is a stock price will deviate from its fair value range at some point in time. So this is just another way of saying that, generally speaking, a stock price isn't always fair valued. It may be fair valued most of the time. It may not be fair valued most of the time. It depends on the stock. It depends on the sector and so forth. But let's say, for example, if the stock price has significantly deviated from its fair price, so it's gone way below its fair price, in other words, or maybe way above its fair value. This gives us a lot of opportunity for movements. So for example, if it's significantly undervalued, that makes it a really easy play for a long, whether I'm going to buy shares, whether I'm going to maybe sell covered calls on it, maybe I'm going to sell poor man's covered call and so forth. If it's significantly overvalued, then I can maybe start buying puts, I can short it. So there's a lot more opportunity when it's outside of its fair value than when it's inside of its fair value, in my opinion. Next up is diversifying into 5 to 10 stocks. This will maximize returns while minimizing risk. This is essentially portfolio theory. 5 to 10 stocks, diversification is a sweet spot. This is due to kind of mathematics and finance about a lot of statistics, really. It's checking at the variation of stocks, the covariance, so the variation of stocks in a group. So not looking at them individually, but looking at them as they're grouped together. And it essentially breaks down to this. So if you put all of your eggs into one basket or one stock and it does poorly, then there's not really much recourse, right? If it goes down, then what can you do? Versus if you have about 5 to 10 stocks and let's say they're not very correlated. So let's say as the market moves, some of your stocks do well, maybe some of them do poorly. Ideally, more of them do well than poorly, but whatever it is. Let's say you pick 10 winners, but they tend to vary over time. So some of them are down, some of them are up. In the moments that you have some stocks that are up, you can kind of cash out of those and start allocating more money to the stocks that are going down, and then kind of repeat this process. So every time you can kind of strip away at your winners and then kind of put more into your losers, in a sense. That's one thought of how you can work into kind of portfolio theory. Another part is that, generally speaking, your your equity will be a lot more stable than the variation if you just had one stock. The movement, like if the market were to go down and you only have one stock and that one stock goes down, your equity is going to go significantly down. If it goes up, it's going to go significantly up. So a lot more variability as opposed to this kind of hedge fund style portfolio where you have a lot of diversification. Next up is that, and this is one of the most important principles, that's why I chose to put it last. An intelligent investor aims to consistently produce profits while minimizing losses. So maybe I should have reversed it, and I think I will reverse it, but I want to focus more on minimizing losses than I do about producing profits. And the other thing I want to specify is I want to consistently perform this. So if your strategy is to kind of go into stocks that have a high variability, a lot of instances where you may kind of, let's say, like not necessarily bankrupt yourself, but just ruin your position. Let's say kind of, I forget what it's called, but essentially you break your, you essentially break your account. So if you decide to break your account, that's not a good position to be in. Ideally, we want to put ourselves in a position where we're pretty safe and we can reliably predict that within the next year, 2 years, 3 years, 4 years down the line, that we're going to be profitable. We don't want to say that, 1 year we're down 50%, the next year we're down 300%. That's not a good consistent strategy, and there's no guarantee that one day you won't just completely break the account. So for me, the most important thing is, am I going to be able to consistently produce profits while also minimizing the losses? Or I really don't want to have any losses. There are instances where you can, and I prefer to mitigate losses than try to be greedy and kind of go after long shots that could potentially jeopardize my account. So I hope that that makes sense as far as the core assumptions. I took a little bit longer on this section because it's a vital aspect of how I view the market and my investing strategies. Next up, some core principles. So I really have two core principles. And the first core principle of investing is you want to invest in excellent companies, and we're going to talk about what that is. One good question of deciding if it's an excellent company is, let's say, for example, if you bought a company today and it's excellent, right? You say, this is great, and the next 6 months it went down by 50%. Would you buy more? And let's say nothing changed within the story, so it's still executing. Guidance is still just the same. There's nothing really going on. It's just that the price dipped about 50%. So nothing at all changed from today to 6 months from now, except for the price. Would you still buy more? Granted, if you had the funds, and that's how you know if you have an excellent company or not. So I like to point to, actually, we'll see an example in just a second, but let's go to our second principle. The next one is investing in undervalued companies. So making sure you get an excellent price for the company. And one other question that kind of goes hand in hand with it is, at what point does it become crazy for the stock price to go lower, and how close is it to that point? So these are two great weights to guide, in my opinion, of whether you find this company to be highly successful and excellent in a sense, and if it's at an excellent price. So if it's crazy to think that the stock price could go even lower, and number two, that if the stock price were to just significantly tank, you would still buy even more. Even though you already had a position, you don't mind going overweight on it. So I'll give you an example. Alphabet, which is essentially Google, this past year, you could see that during about March and April, the price just absolutely tanked on Google. Part of it is because there's this threat and lawsuit over whether it's a monopoly. Another part of it is because the tariffs were just affecting the market sentiment overall, and then that was causing a lot of companies' stock price to drop. But you could see in this case, the PE of Google, and here it's shown as 154, but it really got down to as low as 145. There was a point, I believe, in April that it got down to 145, and the PE was lower than 17. I believe it was like high 16s. But you could see within the past 5 years, the PE, it was down to 17. This is a company that generates about 100 billion per quarter. 25% of that is net profit. $25 billion in profit per quarter. And it's just significant in terms of its profitability. It's significant in terms of its moat. It's just a wonderful company, and this is what I mean by undervalued. So if you look at it within all of its time, you can see that this is just the absolute lowest it's been in terms of PE until back at 2012. So you could think, if it's down at that point, could it go even lower? Is it even crazy to think that it could go even lower? Yes. So, or it's crazy to think that it would even drop even lower. And so this is a great place in time where you could consider, yeah, this is an excellent company based off of a number of reasons we're going to go over. And then also its price is just significantly undervalued. How could it go any lower? That means you got it at an excellent price. So for anyone who was buying it in about March or April this year, kudos, because that was just like a wonderful company, wonderful play. And you can see now it's reverted back to its average PE of around, right now it's about almost 23, so it's slightly overvalued to its average. I think its average is around 21. But you can see that you've made quite a significant profit since then. So those are my core principles: investing in excellent companies at an excellent price, or in undervalued companies. The more undervalued, the better. What are some things that I want to caution about? These are things to be worried about whenever you see within a company or investing strategies just because they could be signs of financial distress. They could be signs of poor investments, in my opinion. And let's take a look. So generally speaking, investing in low market cap stocks are a bad investment just because they can be subject to a lot of manipulation. So low market cap stock is usually around 10 billion or less. 10 billion or less is nothing compared to the large caps. Like if you look at the FANG companies, Nvidia's over $4 trillion, so 10 billion is nothing. 10 billion, to be able to move that, especially with things like leverage, such as like options, is not as hard as you would think, especially with the billions of the billionaires that exist out there, the multimillionaires, hundreds of millionaires. So you could see yourself potentially getting manipulated, or if nothing else, because I don't want to make any accusations, a lot of excessive volatility in play. And whenever you have excessive volatility, that makes it intrinsically a lower price because there's more risk in that stock. Next up is technical analysis, which is, you can refer to it as chart reading. I find this to be very inaccurate. It can be used, but it shouldn't be solely relied on for investing. So if you're only looking at the charts without taking into context the market sentiment, the stock news, without taking into consideration the earnings or anything else except for just, I see this line going up and I think it's going to keep going up, or I think it's going to go down, or I see this line going down and I think it's going to go up or go down. You really don't have sufficient evidence, in my opinion, that you'll be able to predict what the outcome will be. So I do use it slightly in the sense of I like to look at the RSI, I like to use it the MACD to look for divergence, but apart from that, I always take into consideration, more importantly, the fundamentals of the stock. So what's its valuation? Is it going up, and so forth? And we'll take a look at that. But just by itself, if you're just relying on technical analysis, I think it's really poor. And a lot of people who do that, at least the gurus that I've seen on YouTube, they tend to be wrong. A lot of the time, they're just looking to sell you a course, and they don't really, it doesn't really matter if it pans out for them or not, because they'll be selling the course to make profit anyway. Next up, stocks which have a high net loss. So let's say, like, for example, a PE of negative 0.5 or lower, or really any negative PE, but in this case pretty significant. They have no guarantee of future net profit. So this is to say that any stock that's losing money or going through a cash burn is not as safe as one would hope. This tends to be, a lot of times it's expected for new companies just because they're looking to increase revenue over kind of worrying about profitability. A company that just IPO'd, for example, is like, I think, Figma. In that case, they're also probably, I haven't looked at their earnings, but I would imagine that they have a negative PE, and that's simply because they're probably burning some money initially. And when this happens, that's expected. But I don't think it's a worthwhile investment because there's no guarantee that they'll be able to essentially capitalize on that revenue and be able to generate a profit at some point in time. So because I can't do that, there's more risk that's built in, which makes it a lot less worthwhile for me. Next up, taking a short position on a stock is riskier than a long position. This refers back to one of the points that I made in my core assumptions, and that's that the overall market will increase over time. If the overall market increases over time, this means that generally speaking, stocks will get a little bit of a bump, even if they're not doing well. And that's because, once again, the market sentiment does have an impact on individual stocks. So if the overall market does well, then even terrible stocks can kind of get a little bit of a bump upwards. So that makes shorting a stock or buying puts on it much harder. So for that reason, shorting is, or even buying puts is very tough to do. Next up, biomedical companies are unpredictable due to regulations. This is true, and this is the reason why I don't invest in biotech. For example, anytime there's a biomedical company, they have to go through FDA regulations. They have to seek approval from the FDA, and if they're not approved, they're not able to go to the next set of trials. Then that kind of just kills the product potentially or sets it back years. That's a lot of investment that was kind of thrown down the drain, and that can lead to a lot of volatility within the stocks due to that unpredictability of how well or how likely it is that a product will get approved or if the regulations change. For example, look at Hims and Hers, them being able to compound the GLP-1 drugs, that regulation, that those laws affecting whether they're able to do that and if they're going to face a lawsuit. That's a huge unpredictability which can decrease the share price. So I tend not to go into it. The same thing goes for healthcare companies. If you look at what's going on in United Healthcare, or other stocks out there, I believe they're currently under investigation for potentially, I think it was Medicare fraud. Correct me if I'm wrong, if that wasn't the case, but I believe that's what they're under investigation for. Now they may be completely innocent, but that definitely put a hamper on their stock price, and we don't know if maybe those allegations may be true or if they're not true, and what the outcome will be. But it's a highly regulated space, and it's not to say that we can't account for companies having wrongdoing, but it's more so that because they're under more scrutiny in healthcare, that it makes it less reliable and less predictable. Next up, another set of sectors which I would stay away from, or myself that I tend to stay away from, is energy and utility companies. This is because they tend to leverage a high amount of debt to be able to build their infrastructure. And they also have a lot of regulations kind of built in. So say, for example, AT&T or any kind of phone lines, they have to physically put their cables down, or they have to put their satellites up. And that requires a lot of investment for that infrastructure. And so they have to take out a lot of loans or issue a lot of debt, or issue a lot of shares, which therefore dilute your position. And that essentially makes it much more difficult to recoup on your investment. Sure, they might put maybe higher than average dividends, but that doesn't really matter too much if their cash flows decrease or their revenue decreases. Or let's say, for example, from their debt, there's a lot, let's say interest rates rise. If that was the case, if interest rates rise and they're highly leveraged, then that would mean that they're spending a lot more of their cash flow paying off those interest payments. So for myself, once again, not a great investment unless, for example, let's say interest rates go down, then maybe that might be a good time to buy them. But otherwise, I just generally don't look into them. Next up is buying options is incredibly risky, and generally a lot of options will expire worthless. I like to say most options will expire worthless. So if you're a person who tends to buy options, especially retail owners or retail, they tend to buy options with short expiration dates, strike prices which are out of the money, and that can lead to a lot of times them losing all their equity in that position. So I never really recommend buying options. It's or buying any type of options, whether it's calls or puts. Next up is trading poor man's covered calls. This is a way to kind of leverage yourself multiple folds within a company, and I deem it as incredibly risky, just because once again you could potentially leverage yourself 10 times, 20 times as much, based off of what your strike price is, based off of what your expiration date is, and you can in a week in maybe one sudden drop, you can lose most of your equity. So it's pretty dangerous, and there are some specific cases where I would recommend, or where I myself have used or traded poor man's covered calls, but I generally don't recommend it for the average investor, because you have to stay on top of it, you have to watch it, and there's a lot of there's a huge probability that you may lose a significant portion of your equity. Next up is crypto or any security that is not a stock is not regulated or required to report earnings, thereby making it a highly speculative investment. Additionally, covered calls cannot be performed directly on the securities. This is to say that if you're not investing in a stock, then you don't get quarterly reports, you don't get yearly reports. How do you know if that security is going to make you any money? So, for example, when I invest in let's say Coca-Cola, when I invest in Google, I know what its earnings is, and quarter over quarter, I'm able to see if that increases, and that provides me an increased shareholders' equity. So I know I'm making more money. So think of if you owned like a lemonade stand and you bought it for $100, and that year you profited $50. Okay, that's perfect. I don't need anyone else to buy it. I don't need because I can hold on to that lemonade stand, and let's say again next year I make another $50. I was able to recoup on my investment in 2 years, or yeah, in about 2 years. And if I keep holding on to it, I know I'm going to make more and more money off of it. So I don't need anyone to buy my company away from me in order to secure my profits. And I have insights into these because I'm able to see these financial metrics. Now, on the other hand, let's say you're investing into something speculative like crypto or something that doesn't give you these, doesn't really produce any kind of profit or earnings. Then in that case, it's more like playing musical chairs, and you're just hoping that the next person buys it for more than you purchased it for. There's not really a way to make an educated guess that you should be profitable over time, apart from kind of hoping that that would be the case. Because once again, you don't have any financial metrics, and let's say you're investing in a security that doesn't produce any kind of profit. Now, the other thing is, if it is a stock, you can use investing strategies to kind of mitigate loss. For example, if you're investing in a stock, you can sell covered calls, and those will pay you a premium over a specific interval of time, whether it's weeklies, monthlies, quarterlies, and yearlies, and so forth. And that'll help you in the case that the stock price or the value of it does go down. With the premium, you're able to offset the loss. Or let's say, for example, if the stock price were to remain the same, if you were in some kind of other investment, you would have a loss of opportunity cost. That money that you invested in that security, you weren't able to invest it in another item. You're thereby losing money to inflation. However, if you're once again selling covered calls, which you can do on stocks, then you would be able to actually profit in times when the stock was stagnant. So that's why I highly prefer stocks over other securities such as like crypto or anything that really you don't have any financial visibility on, and also you're not able to kind of mitigate risk by using covered calls or other strategies. Next up, companies with a high dividend percentage or price to book ratio of less than 1, they're usually distressed, and which means they're usually at risk of bankruptcy. So price to book is, let's say for example, the book price would be, if I were to sell all the pieces of the company, how much could I get for it? Let's say I get 10 billion, and let's say the price is valued at 10 billion. So its market cap is valued at 10 billion. Then that's a price to book of 1, because it's priced at 10 billion. It's worth 10 billion if you scrap it for parts. Let's do 0.5. So let's say I am valued at 5 billion, and if I scrap it for parts, it's worth 10 billion. So in that case, it's a price to book of 0.5 because it's priced at only half of its book value. And why would this ever be the case? This usually isn't the case. If you ever see this, it's usually because there's some other factors behind the scenes that are making it lean towards bankruptcy, or it might be just that the company is significantly undervalued, but generally speaking, it should give you warning signs if this is the case. The same goes with the next point, which is that companies whose stock price are less than $1, about $1 or less, they're highly distressed. And the reason we know this is because stock prices generally, you want them to be high, but especially higher than $1, because if they're not higher than $1 for X amount of period of time, they get a warning, and if they can't raise their price by that time, then they get delisted. They're off of the stock market. They go onto the OTC, or over the counter, and it becomes much more difficult to invest in them. So usually what happens here is they'll do a reverse split, which means that if you had, like, let's say, reverse split by 10, let's say you had 100 shares and they do a reverse split by 10, then that means that your 100 shares will go into 10 shares, but the price will 10x. Some people think this is good. Generally, this is seen as pretty bearish. This is seen as pretty risky, or it's kind of signs that, once again, that the company is at risk of bankruptcy, because they're not able to. They have to artificially increase their price. There's no other way that they're kind of able to organically increase their price, such as like with good news. Next up, companies which consistently raise capital. So there's different ways to raise capital. They're also considered to be in distressed. So these are companies which have a high cash burn, but they don't have a lot of assets on hand. So because they're kind of burning through cash quarter over quarter, this is typically, once again, new companies or companies that are just doing poorly. They'll issue more loans, or they'll issue stock. And so they can issue more stock, which thereby dilutes your position as a shareholder, or they can take loans, but usually at an unfavorable rate, because if they don't take the loan, then they'll default on payments and go bankrupt. So usually those loans are pretty unfavorable, which means that they're taking more of their cash flows and attributing it to their interest payments. So that's less that they can invest in their own company. Next up, another kind of warning sign is if a company acquisition was significantly overpaid. So if you ever have an instance where, let's say there was some kind of acquisition that took place, that generally is a good sign if it's accretive, the acquisition. However, it's not a good sign when you find out that that most of it was, or a lot of it was goodwill. So what does goodwill mean? Goodwill is kind of a nice way of saying that you just overpaid for something. So let's say, for example, you buy a car and it's worth, let's say, $10,000, or at least it should be worth $10,000, and you paid a markup of $18,000. So you paid total $18,000. You paid the $10,000 plus a markup of $8,000, and you bought it for $18,000, even though it was only worth $10,000. That $8,000 extra that you lost on, that you're not getting back, that's called goodwill. And there are ways to kind of write off goodwill over time, but generally speaking, you're just kind of paying for nothing. You're paying for the name, or you're paying for the mistake. And so there are times when that happens, when an acquisition does take place, and you just lose a lot of value. A good example of this is Elon Musk, when he paid for Twitter. He did pay a premium on it, and he lost quite a bit of money to goodwill. And then afterwards, from his business decisions, the company value kept going down and down. That wasn't the loss of goodwill, but that was just poor executive decisions. Next up, a company which continually performs mergers for revenue growth. So there are companies which, especially early stage companies, they're very much looking to increase their revenue numbers. So let's say each time they report, they're looking to show that they're kind of still a new company, a growth company. And the way they can do that is you can buy, or you can acquire another company, and essentially you acquire their growth, or you acquire their revenue, which makes it seem like you're growing more than you really are, because you did it artificially, right? So let's say, for example, if Google were to buy some other company, its revenue would increase because the company that it bought, it's added now to Google's revenue. That's fine. But sometimes, because they're trying to boost their numbers, they're willing to perform many of these acquisitions, and they're in each deal to acquire. Generally speaking, you're paying a premium on that company. They don't want to just sell you their company. You have to kind of entice them with a little bit extra, and that means you're losing money to goodwill each time. So a little bit of goodwill here, a little bit of goodwill there, and so a little bit of loss here, a little bit of loss there, and it's just generally not a good idea. Next up is these are instances, or these points are specific to the market. So companies which significantly increase in price can be considered overvalued for the short term. So this is where you can use the RSI, and are at risk for a pullback. So generally speaking, there are psychological factors within the market, which I will agree. Technical analysis can kind of take advantage of a little bit. So for example, let's say you have a company or a stock that keeps going high and high and high, and there's a way to see its that strength at which it's been increasing or decreasing. Then its RSI value, typically 40 is a low, 70 is high, so anything above 70 is pretty high, anything below 40 is pretty low. Let's say it's just on fire and it keeps going up and up and up. Psychologically speaking, it should be going down. Also, from a metrics perspective, it probably should be going down because maybe it just it's overvalued PE wise, but it's probably overvalued RSI wise, and that can be an indicator for a pullback. Next up, when the market approaches an all-time high for the first time, so we can imagine in January, I think the SPY was about 610, 620. Then that's a little bit of a risky point where there could be a pullback. There's also instances where psychological points where in intervals of 50 or hundreds, once you reach it, there tends to be a pullback. So when we reach 600s for the first time, there tended to be a pullback. When we reach 500 for the first time, there tended to be a pullback. 650, 550, and so forth. It's just kind of like one of those psychological human quirks where once we hit a certain point, then we think there should be a pullback. And sentiment from people kind of drives more sentiment. So for example, if some people start pulling out and then others notice the price are going down, that kind of cascades and keeps going. The same thing when it's going upwards, but downwards is what we're focusing on right now. Next one is when the customer margin balance is at a high, there's a risk for a short-term pullback. So this is with respect to margin balances overall. So the margin is when you're able to borrow money from your brokerage and use that to purchase more stock. When people are having higher margin balances, that kind of means that you're playing with the house of cards. It's something that's very sensitive because let's say, for example, the stock price dips, people are borrowing to invest. And if the stock price were to dip, they're not only losing their current money, they're losing their current money plus the money that they borrowed from the brokerage. So they're losing at twice the rate, depending on actually how much they're allowed to margin. So let's say if they did 2x margin, then they're losing twice the rate. But if they're allowed to do even more than 2x, I've seen as much as like 4x, then they could be losing 4 times their money with that dip, which could be significant, and they could end up kind of wiping out their whole balance and owing the brokerage as well. So generally instances where people are borrowing lots of money, that's a good time to kind of note that the market's pretty greedy and it could come back.